but you can literally eliminate your taxes from your business today and then never pay tax on the income from the real estate in the future, even when you sell the real estate. I mean, it's unbelievable, the tax benefits in real estate.
Hello, Rich Dad Radio Show, the good news and bad news about taxes. You want to know how the rich make more money and pay less taxes? This is your series. This series is going to be on taxes and real estate. It's really about debt and taxes. The reason Kim and I love debt is it's tax-free money. I just somehow just tickles me to think about that all day long. So I always remind people of this. One of the classics of all times in my world was President Trump during the 2016 debate between Hillary and Donald. Hillary thought she got him. She says, and you don't pay any taxes. And but Donald just simply says, that means I'm smart. And now that pissed off most people. But that's their problem, because he is smart when it comes to taxes. He may not be smart at diplomacy, but see, Hillary and Obama and Biden, they earned their money differently. You know, it's from the swamp. And Trump earns most of his money as an entrepreneur and as a real estate guy. So those are the differences. Any comments, Kim?
Yeah, well, I like these series, and because we, as you just mentioned, there's the 4 asset classes. There's business, real estate, paper assets, stocks, bonds, mutual funds, and commodities, gold, silver, Bitcoin, oil, gas, things like that. And we always say that, you know, you got to find the asset that fits you best. So we always recommend go look at all the different asset classes, see what one fits you best. And then the next piece of it is taxes, because everything is taxed differently depending on how you buy. Real estate can be taxed different ways depending how you buy and when you sell. Same as paper assets, same as commodities. So this is a great series, and we've got 2 great experts, and you'll know now why they are our Rich Dad advisors, because they do advise us, and they advise us well, and they take us far in the. You're going to hold up your quadrant. They take us far in the B quadrant as well as the I investor quadrant. B is for big business, I is for investor. And that's where we all like to play.
And the reason, you know, Trump can make so much money and not pay taxes legally, and we do the same thing, is because we're functionally business owners, we're entrepreneurs, big business. We have brands. Trump is a brand, Rich Dad's a brand. And we do most of our money in real estate. And then we save gold, silver, Bitcoin, and other commodities. One last thing I want to say this because Jim Rickards brought it up the other day. He says the most misused word is diversify. You know, when a financial planner tells you diversify, they really are saying diversify. So you'll say, well, yeah, I'm diversified. I have oil, I have gold, I have real estate, but they're all in paper assets. And there's a difference between paper assets and real gold, real silver, real estate, and real businesses. So a stock is not a real business. It's a share of a business. It's a derivative of a business. So when these effing financial planners tell you you diversify, they're lying to you. Just because you have a paper asset and one of them doesn't mean you're diversified.
And that's what Rickards was saying. He said, and especially given in these times and where we're going in the future, he said the best assets to be in today, this was according to Rickards, Jim Rickards, was real estate, gold, silver.
He doesn't like Bitcoin. I like Bitcoin.
He's not a Bitcoin fan.
Anyhow, with that, we've had Tom introduce. Kenny, introduce yourself, please, to the gang here. And, you know, Kenny is our go-to guy because without him, we wouldn't have made so much money. So it's a combination of Tom and Kenny. You can't do this well, at least I can't. So Kenny, give us an introduction about yourself and how you make us millions and millions and millions and millions in real estate using debt.
Sure. Thanks, Robert. Well, as you guys might know, I wrote the books or the Rich Dad series, the ABCs of real estate investing, and the Advanced Guide and the Property Management book, and you know, but primarily what I do is invest in real estate. So we have multifamily, we have self-storage, we have office, we do land development, and that's what I do full time. My partner Ross and I, we have 250 employees. We're in multiple states, primarily Texas, Arizona, heavily there. And we're buying all the time. In fact, we were talking about 2 deals right before we jumped on the show here today. So, about 500 units that we're about ready to put into escrow. So I use debt, as you know, Robert and Kim. I think why wouldn't you use other people's money? That's basically what it is. It's borrowing money from a bank. People put their deposits in the bank, and then they give them to me to invest in property. And so that's it's the greatest thing ever. And then we only have to come up with the down payments, so we use debt, and then Tom works his miracles on the depreciation side and the bonus depreciation and all the other advantages that we get on the tax side. So we make millions and millions of dollars every year, and we pay very little taxes, and sometimes none.
And
All legally.
yeah, and to your point, Robert, about you can't do this on your own. When we met Kenny, we were doing it on our own, and I was basically handling all the properties, and we didn't have a lot at that time. We had 3 apartment buildings and some single families, and I couldn't handle anymore because that took up all my time. And so when we met Kenny, I'm like, "Oh, yay, can you manage my properties?" And he said, "No." He said, "I cannot." So we only work with like 120 units or more. And that's when the team came together, because as I was doing it on my own, I could only go this far. And I know a lot of people that are in real estate that can't go farther because their time is all they've got. So you've got to bring a team on. So we had Kenny, and then we brought on Tom, and it's the team that lets us grow.
Yeah, this is a very important point. There's most real estate investors I hear, they have a duplex or a fourplex, and then property management gets them.
Yes.
And so what Kenny said to Kim nearly broke her heart. Kenny said,
Oh, no.
he said, Kim was so proud. I have a 30-unit apartment house. Kenny says, it's too small. So not that you can't do the same tax laws, but Kenny can't manage it because in real estate, unlike stocks, see, the reason stocks are good or paper is good is there's no management. But real estate is management, and Kenny comes from the management style. So when Kim and I met him 20 years ago, he was like godsend to us. This guy can manage property. And unless you've been in real estate, you don't know that is the Megillah. If you can manage real estate, you got it, right, Kenny?
Yeah. In fact, even when somebody's giving you money, it doesn't matter who, that's the number one question they ask. Who's your team? How are you going to manage it? Who's going to manage it? Who are they? What's their experience? And so it's the most important thing, because handing somebody money is not that hard, but then having that money produce is hard.
Yes.
So Kenny, how did you get started? I mean, you started as a management guy, right?
Yeah, I did. I started, I was in college, trying to, not rack up a lot of student debt, even though I had some, and I was managing a property, and I was getting paid a whopping $600 a month. And I got a free 1-bedroom, and I was managing an apartment building in downtown Seattle, and I liked it. I actually really liked the business, and I felt like it was really horribly managed when I moved in, and I was like, well, if I just get people in here that can pay rent and I can clean this place up, it'll be a lot less work for me. And I did that. And then the owner came over about 3 months later, and he's like, hey, thanks for cleaning this place up. And, income's up, place looks great. And I was like, I need to be on that side of the desk somehow. So that's when I started to had my mind shift, is like, okay, how do I buy these and then apply these same management principles? And so I've been, as I've been in the management business. We still have a management company. I really, really, really love the business.
Yeah. So you have a book called ABCs of Managing Property.
Yep. ABCs of Property Management. I sure do.
That is the most important book if you plan on being in real estate. If you don't like managing property, people, and toilets, stay in the stock market.
So every week there's something. Trust me, we've had tornadoes, we've had hurricanes, we've had hailstorms, we've had fires, we've had, all kinds of things. That's part of the business, but there is a lot more fun to it than that, actually. When you take somebody's money and you invest it, it's fun, I think, because now there's a way, okay, how do we make this money, make more money? And how do we keep these places full, run them well? And there's a lot to management, and there's a lot of details, as you know.
If you're going to go into real estate, debt is your best asset. And the reason that Ken and I always talk about this is a financial statement, okay? So you have your income, expense, asset, liability. For the people on the B and the I side, the biggest liability is cash.
Yes.
Am I correct, Tom?
Absolutely.
And
It doesn't produce anything.
No,
by
they're
itself.
printing. They're printing it.
Yep.
They're printing it since 1971. They've been printing it. So what happens is when Kim and I make money, income comes in here, and we have cash, we've got to move it into debt.
Right.
We're converting cash into debt as fast as we can. But the key is Kenny's now is property management, and then investor management and market management. So that's why anybody saving cash today and living debt free, it's good advice if you want to be poor.
Correct.
Now, but don't switch into real estate unless you're willing to understand what Kenny knows about real estate. So that's why his 3 books. Give us your 3 books again, Kenny.
The ABCs of real estate investing, the ABCs of property management, and then we have an advanced guide to real estate investing.
And that's what you need to understand, because when you say move your money into debt, if you don't know what you're doing and you're buying a property and you have no education, you have no experience, you don't know what you're doing, that debt's going to be bad debt.
And I remember your dad, Kim, her dad was hardcore stock guy. You know, he was hardcore buy, hold, and pray in the stock market. And that worked for him. But I told him we're buying real estate. He says, I refuse to fix toilets. Well, so
that was my plan. I was going to have Dad was going to be a business partner. My dad was going to be my business partner on this property. And I called him up. I said, what do you think about buying this little single family house? Well, I don't want to fix property, and I don't want tenants calling me at this time of day, and I don't want to fix leaky roofs. And I'm like, I don't think I want to do this. I said, I don't think you do either. Thank you very much.
So just remember, paper assets are for some people. Commodities, gold, silver, oil for some people. Businesses are for some people, and real estate is the best, because right now, the problem with Kim and I, our income is going up. And if Kenny doesn't find us a property pretty soon, we're going to pay taxes. So Tom, would you explain that psychology? Because this is on the B and the I side.
And because Tom, when we talk about taxes, Tom always says, can you find another property? Can you find another property?
Can you get more debt?
Yeah.
The tax law is a series of incentives to do what the government wants done. And one of the things the government wants done is they want housing built, okay? And they want commercial property built. So what they do is they say, well, we'll give you a tax benefit so that you're willing to go and risk your money, put in the effort and the time to go get, and to borrow money as well, because the government, of course, wants you to borrow money because that increases the amount of cash in the economy. And so it's all good for the economy. So what happens is the benefit that they give is what's called the primary benefits, what's called depreciation. And depreciation is magic, okay? Because while your property is going up in value and you're increasing your rents, you're actually getting a deduction for more than what you paid, because you get a deduction not only for the amount of money you put in, but you get a deduction for the amount of money the bank put in. So the debt is important, you know, from a return standpoint, but it's also important from a tax standpoint. So critical that you understand debt if you're going to get into real estate and get the tax savings that you guys talk about.
So let me show you in a picture. Okay. So let's say Kim and I have $1 million coming in from our businesses. It's a liability to us because they're printing more money today. So I want to take this $1 million over here. I want to give it to Kenny. He's going to amp it up to 10 million. And exactly as you said, because the government wants you to borrow money, because the dollar became debt in 1971 when Nixon took the dollar off the gold standard. They dropped the interest rates because they want you to borrow money. If they don't want you to borrow money, they'll raise interest rates. It's really that simple. So let's say it goes to 1 million here to 10 million here. What that does is reduce taxes here. Is that correct, Tom?
Right, because that $1 million is not just a liability because they're printing it, but it's a liability because there's $400,000 of taxes associated with that $1 million of income. And really one of the best ways to get rid of that $400,000 tax liability is to take that money and convert it into real estate, because then the government gives you this big deduction for your money, for the bank's money, and it offsets that $1 million of taxable income. Your taxes go away.
So that's why, Kenny hears a panic in our voices all the time. Kenny, have you found another property yet? Because if he doesn't find any property, Tom is going to make me pay taxes. Is that correct, Tom?
The IRS is going to make you pay. I'm going to file the tax.
And just to be clear,
really clear here.
And also to be clear, this formula is not just a U.S. formula. This formula is worldwide, correct?
It is. The U.S. right now has the best tax laws in the world when it comes to real estate. There's no question. But every country allows depreciation on investment real estate.
Final words, Ken. We have about 1 minute. So what do you have to say? Because this is why we're always calling you. We have too much cash. You have got to provide this for us so we can go into debt here and we can reduce taxes. Does that fit your psychology, your belief system?
Oh, yeah. I mean, Tom always says it perfectly, in my opinion. He says, if you want to see what the IRS wants, just look at their codes. And what the IRS wants us to do is invest in housing, period. And that's why we get the benefits from it. So we invest that money, we get the debt from the bank, and we're beating inflation. And then with depreciation and other things, we're actually able to take that money out tax-free. So we're getting income. So we're investing our money, we're getting our income tax-free. And if it's a value add deal, which you guys have been involved in a lot of with us, then you actually get your money back. And then we have, of course, what we call infinite return, which is you've now gotten your money back and you paid no tax, and that's a cash out refi. So you don't pay any tax on that, and you still get income. So you give me money, I give it back, and you pay tax legally, over that depreciation amount only.
So let me explain what he just said. So this $10 million property, it's throwing income here. Cash flow. Let's say it goes up to 20 million. What Kenny's talking about is we borrow out the gain, and that comes to us tax-free, but that's now tax-free money. So we go from 10 million to 20 million due to inflation, or what do you want to call it.
Well, I call that forced equity. So I buy a property at 10 million with the idea of bringing it to 20 before I buy
That's
it.
the value add, yes.
I already know how I'm going to do it. It's not just market driven. We're actually doing things to make it worth 20.
Yeah. So when Kenny pitches the deal to us, we already know we're going to put $1 million here. It's going to go to 10. It's going to go to 20. We're already getting income from the property. When the property goes to 20, we borrow out the 10 tax-free. Is that correct, Tom?
Well, that's right. And then you borrow out the 10, but then you reinvest that 10 into new property, because you've got to constantly be investing in real estate. That's why I'm always after you guys. Look, you're making money. We need to constantly be reinvesting that money into real estate. And that's really how this system works. Now, real estate, let me say one last thing on the importance of real estate from a tax standpoint. It is one of the few places where you can actually reduce your taxes today and never pay taxes in the future. Now, you've got to have the right financial education. You've got to have the right tax advice, but you can literally eliminate your taxes from your business today and never pay tax on the income from the real estate in the future, even when you sell the real estate. I mean, it's unbelievable, the tax benefits in real estate.
Yeah. And that's why Hillary was going after Donald Trump. He said, well, you don't pay taxes. And he says, that means I'm smart. But they don't teach you this in school, but they'll tell you put your money in a 401k, which to me is a loser's game, but it's better than nothing. And don't do this at home if you don't know anything about real estate, because property management is the hardest part of this game. So when we come back, we'll be going more into why real estate is, in my opinion, the best income, especially if you don't want to pay taxes. We'll be right back.
Are you worried about your financial security in these unprecedented times? If you are, the next minute could profoundly impact your financial security. Imagine waking up to find the economy has plunged and your portfolio has plummeted 30 to 45%, while banks are in turmoil, holding your money hostage while waiting for FDIC intervention. Where would you turn? For many, this may sound like fiction, but it's a stark reality. For those that have money on the line, recently, America's awoke to both the NASDAQ and the Dow, plummeting over 1,100 points each and triggering a frenzy of sell-offs. History shows us how a single event can crash the market, like the dot-com bubble of 1999, the subprime mortgage crisis of 2008, and the pandemic of 2020. But today, we're facing multiple bubbles: commercial real estate, stock, bonds, and banks. Combined with the relentless inflation, the threat of global recession, the specters of war, and you have the perfect storm. The consequences could be catastrophic, plunging us into unprecedented crisis. America is sliding in the age of discord, with trust in institutions collapsing and the democratic norms unraveling. The quality of life for Americans has declined. Wealth is concentrated among the rich, while the median American family income stagnates, creating a dangerously top-heavy social pyramid. Moreover, hostile countries like Russia, China, and Iran are working to destroy the U.S. dollar. Gold is a no-matter-what store of wealth that you need. That's why Robert has been such an advocate of gold, and he trusts Allegiance Gold. Allegiance Gold is ready to help you incorporate physical gold as part of your portfolio and protect it against economic uncertainty. Visit protectwithrobert.com today to learn how you can qualify for up to $5,000 in free silver with a qualifying investment. Or give them a call at 844-3-ROBERT. Remember to mention Robert and Kim sent you when you contact Allegiance Gold. Secure your IRA or 401k today with Allegiance Gold. Visit protectwithrobert.com or call 844-3-ROBERT.
Welcome back, Robert Kiyosaki, the Rich Dad Radio Show. The good news and bad news about taxes, and why the rich don't pay any taxes legally, and why the employee and the small business owner pays the most taxes. We're going to tax the rich. Well, they don't tax the rich. They tax the poor and middle class. And that's the tragedy of this whole thing. Plus, they're going to print money, which causes inflation, which is a tax. And then they're going to raise the minimum wage to $15, which is another tax. And so that's why if you really don't want to pay taxes and make a lot of money, that's why this 4-part series at the Rich Dad radio program is about how the rich make more money and pay less taxes legally. It's the people who are on the E and the S side are the ones who cheat. Any comments, Kim?
Well, yes. And as I've said before, taxes are so misunderstood and everybody thinks taxes are evil. But as Ken and as Tom were saying, that taxes are an incentive for doing what the government doesn't want to do. So they're giving us tax breaks to do what the government doesn't want to do, create housing, create office buildings, things like that.
And borrow money.
So I think this series is very, very important because the more you understand about taxes, the more sophisticated and better decisions you're going to make as you go into your world of investing.
And for those of you listening on the radio, you can't see this. That's why we have cash flow clubs of the cash flow game, because you can't learn this stuff by thinking about it anyway. The beauty of a cash flow game is you have to do it, be and do it. And if you don't want to do it, then buy a 401k and pray. I mean, that's really where it's about. So our guests today are, again, our tax advisor, Tom Wheelwright, and our real estate partner, Ken McElroy. Because Ken has made us wealthier over and over and over again. In 2008, when the market crashed, we all thought we died and went to heaven because the real estate prices dropped, but so did interest rates. And so as soon as the market real estate dropped and interest rates dropped, Kenny says, I'm going to borrow $300 million. Now, most people would be on life support after that, gasping for air. But Kim and I got sexually stimulated, thinking about, $300 million in real estate borrowed is going to lever up to almost $750 million, which means we make more money and pay less taxes. And when Kenny builds into his business plan that he's going to take that he's going to make the property more valuable, and we're going to borrow out the equity. We don't have to flip the property. So when we borrow out the equity, again, we don't pay any taxes. Any comments on that, Tom?
Well, yeah, for sure. I mean, first of all, the reason you don't pay tax when you borrow money is because that money is still owed to somebody. And so it's not income to you. You're going to have to pay it back. But the great thing about real estate, of course, is that your tenants are going to pay that back. All along the way, the government's going to give you this incentive called depreciation and allow you to use that depreciation to offset that income coming from the tenants that's paying down or amortizing your debt. So it's kind of the perfect storm in a good way. Let me add one more quick thing about when he says tax rich, he's talking about the high earning employees. That's who he's going after, is the high earning employees and small businesses. It's the E and the S. That's who he's going after. He is not going after the B and the I, and especially the I. The I is never going to change because that's where the government gets most of its work done. And while it might shift from oil and gas to solar, it's still the same thing. It's an incentive to do what the government wants done. That's right. In the inside investor, that I quadrant, and that's where you get zero tax.
And it's all based on debt and taxes. So when somebody says live debt free, I check out
Well, you're going
because
to pay a lot of taxes if you don't have any debt.
yeah, and the reason is 1971 when Nixon took the dollar off the gold standard, the dollar became debt. And the only way money is created is when you borrow money. That's why they want you to have credit cards and all this, because if you stop borrowing, the whole economy seizes up. Comments on that, Kenny?
Yeah, well, I think the other thing that a lot of people miss is that when we look at real estate, we look at real estate from a long-term cash flow standpoint. We're not trying to time things. Obviously, we don't want to buy at the top, just like anybody doesn't want to buy at the top. But if it cash flows, even today, as hot as the market is, if it cash flows, we actually buy it. So that's why I'm still buying, is if the numbers make sense. And so we've always been cash flow driven, and we've always been, how do we use the real estate to pay less tax legally? And that is the rules of the game. And when Hillary said that, what I thought about immediately was, it made her look stupid because she doesn't know the rules of the game. There's rules around all this stuff, guys. And this is not, this is stuff that you can learn. Anybody can learn this stuff. And we're all playing by the same rules. She just didn't understand them.
Yeah, but Robert, you said something earlier about when the market crashed. In 2008, when the market crashed, we did very, very well. So one of the keys to financial education is we knew, and Kenny and Tom and Andy Tanner with paper assets, cash flowing paper assets, when the market goes down, we do really, really well. For the average guy, girl out there, when the market crashes, they crash too. Their 401k crashes, their retirement plan crashes. They don't know how to make money when the markets crash. So that's really the key importance, I think, for financial education, because there is going to be a crash. And are you prepared, and can you take advantage of it?
And the tax law wants you to borrow money. And I think it's funny when somebody asked me the other day, Kenny says, what's your net worth? I said, about a negative billion.
Yeah.
They don't realize that debt is money.
Right.
It became money in 1971. And the more money I borrow, it's tax-free money. Is that correct, Tom?
That's exactly right. Tax-free.
The government wants you to borrow money because if we don't borrow money, the whole frickin' economy grinds to a halt. Am I correct on that one?
It's just like you said, Kim, the tax law is incentive to do what the government wants done. Well, one of the things the government wants done is they want that money borrowed from the banks to flow through the economy. And so the not being taxed on debt is an incentive to borrow. And we can't ignore that that's what it is. It's an absolute tax incentive to go borrow money.
And there's one more advantage I want to talk about, Kenny, and this is the brilliance of his financial plan is this. So Kim and I make money here.
In the income column.
In the income column. And then that means we pay more taxes. So we got this cash here. We move it to Kenny, and let's say we go from 1 million to 10 million. His business plan is going to take that property up to 20 million. And then we're going to borrow out the 10 million. So it's 10 million tax free. So the thing I want to talk about is, Kenny, when, that property we saw, I think it was in Texas, was 400 units. Vacancy was 900%. The place was empty. The prior tenant was a real thief and went in there and stole all the copper wire and all the, just tore everything apart. This place was a mess. There was nobody living there, and they weren't collecting rent.
And there was a fire.
And there was a fire. And I walked in there, and Kenny and I look at this thing, and there's a toilet. The toilet had been taken out, and the guy was sitting in front on the toilet in front of the fireplace. And I go, I'm walking out of here, and Kenny goes, oh, this is wonderful. This is wonderful. Remember that one?
Of course, I have a lot of stories like that. If the property was incredibly well located, as you know, it was very, very poorly run and very poorly managed, to the point that the bank actually took it back. It was owned by Bank of America. That's what's happening next. Kim kind of touched on this. Banks actually get in trouble when they get their loans back. That's not a good thing. That's called toxic debt. And it affects the bank a lot, from a share price, from being able to lend more money and all. It's not a good thing. So it was owned by the bank because of the prior owner and the prior management. He tried to do his own management in-house and ran the thing into the ground. The bank took it back. This is a very common story. The reason we bought it, the bones were good. I always like to say the bones are good, and the location was amazing, of course, being right next to USAA Insurance in San Antonio, which is a massive employer. I think last I checked, there was like 15,000 people that work there. So, for me, it's, it's just fixing it back up and getting it. And what happens is the whole neighborhood loves you. Because the people living there and all the things that are going on, the city council, the mayor, they all know what's happening at these places. And so when you go in and buy something and infuse new life into it and fix it up and get better people in there, and the thing starts humming along and running the way it's supposed to run, the whole community embraces you. And we took that property. If you remember, we bought it for, I bought the note for $20 million from the Bank of America. I put 7.5 into it. When we were done 2 years later, it was worth $42 million. And we put debt on it. We paid everybody back their initial investment, and we've owned that thing cash free. We have no investment in that deal. We still own it today. It kicks off $1 million a year of cash flow.
So not only Kim and I donated part of the $1 million here,
The asset column.
the $7 million in from the because cash is a liability to us because they're printing it. So it goes in here, you put it into $20 million, you ramp it up to 40. And meanwhile, we're getting cash flow. And Tom, why are we paying no taxes on all this?
Well, because first of all, you're paying no tax on the debt because you're going to pay that back. Second of all, you're not paying tax on the income from your business because the depreciation from the real estate is offsetting that income. So here's the thing.
It's the income from Rich Dad.
Right.
You understand that the reason we're B's and I's is that by investing in real estate, in the B, we make the money in the B, and we invest with Kenny in the I, and that offsets our taxes in the B. Am I correct, Tom?
That's correct. Now, one thing that you mention all the time is in the I quadrant, that's not just any investor, that's the inside investor. And that's very important in the US, especially if you're a casual investor, you don't get the same benefits. You must be a professional investor and an inside investor. And then not only do you get, all the better interest rates, you get the better deals, you get things before they come on market, et cetera, but you also get better tax results because Kim is an inside investor. She's professional. She's a professional in real estate. She spends a lot of time at real estate, and that's what allows her to get these tax benefits that the average casual investor is never going to get because they don't understand how the law works.
So this is where Kenny kicks in. So we saw this piece of crap property. I was ready to run. When I saw that, that toilet in front of the fireplace is burned in my mind. And I realized the guy who owned it before we did, his business plan was to just strip it. Is that correct? He collected all the rents and stripped it. That was his business plan. So Kenny goes in there with his team. And I didn't believe Kenny. I saw his team. I forget your guy. This guy, he looked at it. He was just as excited as Kenny because he knew he could fix it. Is that correct?
Yeah, he was an expert. He was an ex-Marine like you. He was mission driven. He knew exactly what we needed to do. Again, Robert, once you start to do this, whether it's one unit, in this particular case, it was 400 that we needed to fix. It was a 680 unit property. It's just math. Literally, some units are $1,000, some units are $10,000. You have to figure all that out before you buy it. That was a big number. That's why we raised all that extra money. And the bank wants that, the community wants that, everybody wants that. Everybody wants somebody. It's no different than if it's a house in the exact same condition.
But it's also part of your formula, Kenny, and you touched on it earlier. Your formula is number one, you like properties with problems, but number two is you look for a property where there's jobs. And that fit that core formula to a T.
Right. And it's easy to buy something that's fully, 100% occupied. You're not going to move the needle a lot there. I'd rather personally buy something that's 100% vacant and then figure out how to occupy it. And that's management. And then that also, if if the building is vacant, it's worth a lot less than if it's full.
Yeah. And that's how you double your the worth of your property.
So keeping the math simple. So Kim and I have $1 million on, to us, the cash is a liability that's coming from Rich Dad. We move it into the 20 million.
In the asset
it goes
column.
in the asset column. We turn it into debt. We took cash, convert to debt. Kenny improves the property to 40 million. So meanwhile, we're making all this cash flow from the original $20 million debt. Well, let's say he raises it to 40. That 20 million comes out as debt. Why is that tax-free, Tom?
Because you have to pay it back. So the government says it's not your money, it's the bank's money. You're using their money, but you have to pay it back. So you're not taxed on it. But here's what's even better. Not only are you not taxed on the debt, you get to deduct the interest. So if you put your own money in, you don't get to deduct the cost of putting your own money in. But if you borrow the bank's money, you get to deduct the cost of putting their money in. And by the way, that's something that's true all over the world. All over the world, you get to deduct interest expense, but you don't get to deduct the amount of money you put in as capital.
So Kenny, that's called because when I met Kenny for the first time, this is 20-something years ago, everybody was flipping property. Remember that?
Of course. Yep. They're doing it again right now.
Yep. Tom, what happens when you flip?
You have the worst kind of income, what I call earned income, which is like ordinary income with the additional tax of Social Security on top of the ordinary income. So you're at the super highest rate. That 60% bracket that you talk about in the S quadrant, that's for flippers.
And let me ask you one more thing, Tom, because here's one other huge tax benefit that I like. Okay, let's say you have a property and you're going to put down 20% of the 100% cost. You put down the 20% in cash, but you still get 100% of the tax benefits, correct?
That is correct. So you leverage your tax benefits. In other words, you get 5 times the tax benefits than if you just than if you paid cash for it.
In the tax law, which is Tom's book, Tax-Free Wealth, there's appreciation, depreciation, and amortization.
Right.
So by doing this formula, appreciation is tax-free.
Correct.
Depreciation is income.
It's a tax benefit.
Tax benefit. And amortization is the bank gets their money back. That's tax-free money too.
Well, that's tax-free because the depreciation covers that. It would be otherwise taxable, but because you've got depreciation, it offsets that amortization.
I'm watching Kenny getting sexually stimulated thinking about this.
Kenny hasn't paid taxes since he was a kid.
A long time.
That was a long time ago.
So again, this is a team sport. Don't do this on your own.
No.
I mean, Kenny definitely could not fix that toilet. I know that for certain. But the guy he brought in, he was all excited about it because I saw this toilet as a horrible thing sitting in front of the fireplace with all the copper wire ripped out of the drywall. I was ready to run. It was like 80% vacant. It was a nightmare. But to Kenny on the finance side, it was an opportunity because he knew his business plan was to take it from 25 to about 45 million.
And going back to where we first started talking about when we met and Kenny said, I can't manage your 60 units, 70 units because it's too small, is because he had this whole team that he has on his side that would be too small for his team to manage, and it wouldn't bring him any financial benefit as well.
Yeah. So
that's the importance of a team.
It doesn't mean don't start small.
No, start small.
Start small.
Yeah.
But the benefit is you always have dreams of going to big on this side here. Right, Kenny? Because you started as a property manager in college.
Absolutely. I started, well, actually, my first investment was a 2-bedroom, 2-bath. I used my own money. And now, the deals that we're doing obviously require like $20 million down. And, I use other people's money. So you go from, using your own to learning how to use other people's. And that's actually the way the system is set up.
Capitalism.
Yeah, it's literally set up. Even people put their money in insurance policies and pension plans and 401ks and all that kind of stuff. There are people managing that money. And when you get your statement, somebody is putting it somewhere to make it, make that money. So, and so you just want to be on that side of it. We borrowed from insurance companies. We borrowed from pension groups. We borrowed from banks. We borrowed from life companies. People, when all this stockpile of money people are investing or saving, it needs to go to use. So there's a velocity of money that has to happen somehow, and so they look for people like our company.
And my final comment is, if you're starting small and you're just starting, don't use other people's money until you know what the hell you're doing, because that's a big responsibility. That's a big responsibility. Learn on your own money for a little bit. That's what Kenny did. That's what we did. And then once you've got the experience, you got the knowledge, then you can take it to the next level.
Yeah. And please get, if you want to go to the next level, start small, get Tom's book and get Kenny's 3 books, because it's a very sophisticated game. It's what capitalists do. It's what Donald Trump does and Hillary doesn't. So those are the differences there. So anyway, I want to thank the two of you. Thanks for making us fair. The thing that's really funny is Kenny keeps giving back our money. And our problem is we have to give it back to him.
He just keeps it. He pretty much just keeps it.
It goes in the left pocket and comes back to the right.
all the time, in and out.
So Kenny says, I have 10 million for you. So where are we going to put it?
Yeah.
Because if I take that money, it becomes tax. I've got to move it back into debt, got to move it back into, and then Kenny's got to have a business plan that's going to take the 10 million, let's say, turn it into 20 million. Final words, Tom.
So this is great. Seriously, taxes is a complex game. So don't think it's that simple. I would echo your point, Kim. Start with your own money, start with your small deals. But remember that as you get more experience and more education, you're going to need up your team as well. I mean, you guys, let's face it, you haven't always had me and Kenny on your team. So you had to up your game too. And as you upped your game, you had to increase the level of your team members. And that's critical, because not everybody, you can pay a lot of tax and still own real estate if you don't have the right team members.
Correct. Great point.
Final words, Kenny, and thanks for your time today, because you're putting another big deal together, and please put it together, because I don't want to pay any more taxes.
Well, first of all, I want everybody to know that we all kind of started without knowledge, all of us. Even on this call here and this Zoom, and I didn't know how to do any of this stuff in the beginning, and I just learned, and I said, well, if that person can do it, how did they do it? And I was surrounded by family members and friends that they just said, you can't do that. There's no way to do that. And I learned how to do that. And now they're like, how did he do that? And so the point is you have to surround yourself with people that know how to do it. Ask a lot of questions. That's definitely achievable.
Yeah. And I think the best statement you made was when you did a good job managing that guy's property, but the check went from you to him.
It did. It went the wrong way.
Talk about a wake-up call.
Yeah, well, I know. I increased the value of his real estate a lot, which was my job, by the way. I'm glad I did it. I'm proud that I did it. He was happy. I was happy. But, he got the benefit.
Yeah, and the tax breaks.
Yeah.
So anyway, thank you guys.
You bet.
Final words
You
for
guys,
next
as
time.
always.
Bye.
This podcast is a presentation of Rich Dad Media Network.